Hello, this is an introduction to liabilities. In this series, we're going to focus on current liabilities and also explain contingencies. So what is a liability? Well, the proper definition is a probable future sacrifice of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. My definition is it's a responsibility to others. In other words, it's a promise you make that you must fulfill in the future. There are two types, current and long-term. Also, liabilities are grouped by whether they're definitely determinable, meaning you know the date, you know the amount, and you know who you owe the resources to. So those you make journal entries for, and they show up on your financial statements. Also showing up on your financial statements are your accruals. They're estimated as far as their amount, but we recognize them as a liability due to the matching principle, which says that expenses follow the revenues that were generated in that period. Also, we'll talk about contingencies, and contingencies are a liability or a potential liability that is dependent upon whether a future event takes place or not. So it doesn't become a liability until that future event triggers that liability. And finally, commitments. Commitments are legal agreements where you have agreed to do something but haven't yet taken the steps to do it, and both contingencies and commitments are reflected in the footnotes to the financial statements. So let's take a look at what we can classify as definitely determinable, estimated, a commitment, or a contingency. So here's a list. So dividends payable. Well, dividends payable, I know it's going to be definitely determinable because I know the date that I need to pay the dividend, the amount of the dividend, and who I will pay it to. Whereas pending litigation is a contingency because you really don't know what's going to happen until that lawsuit gets settled. So it's contingent upon a future event. Income taxes payable is an example of one that is estimated, and we make that estimate in an adjusting journal entry at the end of every period. And you're saying, well, I know how much my taxes are. Yes, you do, but first you have to prepare the tax return, which is generally after the close of the year. So at the close of the year, when you're recognizing or matching those revenues and expenses, it's only an estimate at that time. So that's why it's estimated. Current portion of long-term debt is definitely determinable because you know who you owe it to, how much, and when it is due. Vacation pay liability is an estimate that we accrue at the end of the year, and the reason is you will individuals or employees earn vacation, but they don't get the pay until they take their vacation at some time in the future or when they quit. So vacation pay is an estimate, and we must accrue it at the end of the year. Guaranteeing loans of another company is a contingency, and it's contingent upon the other company not paying, and thus it falls to us to pay their loans. And the final one is purchase agreement, and that's a legal document or a commitment that the company is making to say that yes, that company will be a preferred supplier in the future year. So those are some examples of liabilities.